if you are already familiar with the key IFRS 17 concepts and requirements. But if you want to zoom in on the technical details and see how they are going to play out in the specific situations, then this series of videos is for you. I'm Pawel Wozniak from 3blogs, and this is Zoom In on IFRS 17. This episode is about the accounting treatment of revenue under the building blocks approach. Currently, the premium is the salient measure of an insurance company's size and performance, monitored closely by investors, regulators, and other stakeholders. Yet, the treatment of premiums under the new insurance contracts IFRS is going to be fundamentally different than it is now. Under the current standard, revenue directly corresponds to premiums, while under IFRS 17, we've got a revenue recognition mechanism that doesn't follow the premium collection pattern. The new standard defines revenue as a reduction in the liability for the future coverage because of services provided in the period. Looking at it from a different angle, we recognize in revenue this portion of premiums that corresponds to the reduction in the liability. Let's see how it works with an example. Year in and year out, insurance companies collect premiums, pay claims, pay expenses, incur acquisition costs, but also run off the risk related to the insurance portfolios. An excess of premiums over these elements includes a profit component, and this profit component is, wait for it, the contractual service margin, the CSM. Well, this picture may not be the best explanation of the CSM, but for one thing, it's intended to demonstrate the revenue recognition, so I simplified the CSM bit. As I said earlier, revenue is a reduction in the liability for the future coverage because of services provided in the period. This reduction is driven by four components. Let's look at them one by one. First, claims and expenses expected to be paid in the period. Second, acquisition costs recognized in the period. Third, release of the risk adjustment. And fourth, release of, you know what, I mean the release of the CSM. The revenue recognition pattern related to the acquisition costs is different than that for claims and expenses. Revenue related to claims and expenses corresponds to the projected cash flows, while in case of the acquisition costs, it's not cash flows based. Let me say it again. Revenue related to claims and expenses corresponds to the projected cash flows, while in case of the acquisition costs, it's not cash flows based. The International Accounting Standards Board decided to include this exception to eliminate the day one revenue peak related to the initial acquisition costs. Apparently, they don't like the day one peaks. After all, they contrived, you know what, to eliminate the day one gain, right? Also, we may ask what has happened to the premiums. All in all, premiums are part of the liabilities cash flow projections. So, if revenue is a reduction in this liability, then surely the premiums should be taken into account, right? And yes, they are taken into account, but through the CSM mechanism that spreads profits over the insurance period, without regard to the premiums collection time. Before we move to the accounting journal entries for revenue, let's look at the relation between premiums and revenue in case of the unit-linked product. Under IFRS 4, the whole amount of this premium is recognized as revenue, while under IFRS 17, we only take into account these four components I talked about earlier. Typically, most of the unit-linked premium represents an investment component, and this investment component doesn't go through an income statement at all. In this episode, I would like to focus on the accounting journal entries, so let's see how revenue will be accounted for under the new standard. Expected claims and expenses are debited to the fulfillment cash flows component of the insurance liability. On the other side, these amounts are credited to the revenue account.
When it comes to the portion of revenue related to the acquisition costs, it is made of two parts. The first part is made of the acquisition costs paid before the related insurance liability is recognized. Such costs are deferred, and then when the related insurance liability is recognized, they are debited to the CSM. The second part is made of the projected acquisition costs that will be paid in future. Such costs constitute the fulfillment cash flows and are initially accounted for in the same way as the other projected expenses. At subsequent time points, the quasi-DAC is amortized to expenses with the same amount recognized as revenue. I say quasi because we do not have an explicit DAC asset in the balance sheet. At the same time, a reduction in fulfillment cash flows related to the acquisition costs is recognized as revenue with the actual acquisition cost payments accounted to expenses. So coming back to our list of journal entries, we have got acquisition costs released to revenue from the fulfillment cash flows and acquisition costs related to the quasi-DAC amortization. Then we have the release of the risk adjustment and last but not least, the release of the CSM. We should also remember that the portion of the risk adjustment movement that does not represent the revenue goes to the CSM.
Let's wrap up what we have just analyzed. The revenue is driven by four elements, with the acquisition cost element being additionally made of two parts. Also, the acquisition costs and the related revenue is recognized over the insurance period in a systematic way, so it doesn't follow the actual payments. To conclude this episode of Zoom In on IFRS 17, I would like to recommend two things you can do to stay on top of the game.
First, you may join the IFRS 17 LinkedIn group dedicated to the implementation of the new insurance contracts IFRS. Second, you may visit our website where you can find a plethora of materials including videos, presentations and articles.
You will find the relevant links below in the description of this video. Thank you for watching, and I hope I whetted your appetite for more IFRS 17 insights.